The 78,710 should have been a bestseller. Instead, it's the Dreamliner nobody wanted. American and Delta skipped it entirely. But United, they doubled down, filling their Newark to Chicago to Europe routes with a jet most competitors won't touch. Is this a genius optimization or a dangerous overreach? To understand, we need to look at when Boeing launched the Dreamliner program. They had a simple plan: build a family of aircraft that could replace basically everything airlines were flying. The 7878 came first. About 250 passengers, 7.35 nautical miles of range. Airlines could finally make money on thin routes that never worked before. Doha to Lisbon, London to Baltimore. Routes that seemed impossible suddenly became profitable. Boeing saw the success and thought bigger. They stretched the fuselage, created the 7879, and somehow kept most of that incredible range. Airlines went crazy for it. The 7879 became the Goldilocks aircraft. Not too big, not too small, could fly anywhere. Today, it represents over half of all Dreamliner sales. But Boeing's executives looked at the market and saw dollar signs everywhere. Airlines were still flying older wide bodies. So what if Boeing could build something that seated around 330 passengers while keeping Dreamliner efficiency? The 78710 was born from that ambition, and that's where everything went? Well, a little strategically misguided? Here's the problem nobody talks about. The 78710 can only fly 6,330 nautical miles with a full passenger load, probably even less. You know what that means? The world's biggest Dreamliner has a shorter range than the aircraft Boeing built in the 1990s. Try flying from New York to Mumbai. About 7,770 nautical miles. The 7879 handles it easily. The 78710, it literally cannot complete the journey with a full load. You'd have to dump passengers, dump cargo, or make a fuel stop. All of those options destroy the economics that make you buy the aircraft in the first place. But here's what really stings. Airbus built the A350-900 with similar capacity and more range. Same number of passengers, thousands of miles further. For most airlines, this became a no-brainer. Why would you buy an aircraft that can't reach major destinations when your competitor offers the same capacity with global reach? Most airlines asked exactly that question and walked away. The numbers don't lie. Boeing has received orders for 435 total 787-10 compared to 2,200 for the other Dreamliners in total. That's disappointing for what was supposed to be a volume seller. Airlines want flexibility. They want aircraft that can adapt when routes change, when demand shifts, when the world throws curveballs. The 78710 offers incredible efficiency, but only if you use it exactly how Boeing intended. Step outside that narrow operational envelope, you're stuck with an expensive aircraft that can't reach where you need to go. Delta opted for the A350-900's 8,000 nautical mile range to prioritize flexibility, proving airlines valued global reach over the 78710's capacity-driven efficiency for high-density regional routes. American focused on 787-9s. A lot of European carriers mostly ignored the 78710 entirely. Even Asian airlines, who typically love high-capacity aircraft, bought only small numbers. The message was clear. Efficiency isn't worth sacrificing flexibility. But United heard a different message entirely, and what they saw would change everything. While everyone else saw limitations, United saw a laser-focused opportunity. Look at United's route map. Newark and Chicago to Europe. These aren't experimental routes. They're United's bread and butter. Flown multiple times daily. Every single one falls perfectly within the 78710's range and capacity. More importantly, they're all packed with business travelers willing to pay premium fares for premium service. United realized something brilliant. They didn't need every aircraft to fly everywhere. It needed the perfect aircraft for their most profitable routes. On a new-to-Europe flight, the 78710 can carry 330 passengers compared to 250 to 280 in smaller 787s. That's not just more revenue, that's a significant competitive edge. United can offer more seats, charge lower fares, and still make more money per flight. But the real genius was fleet commonality. United already operated dozens of 787-9s, same cockpit, same maintenance, same crew training. Adding 787-10s meant expanding capacity without expanding complexity. But would this strategy actually work in practice? United didn't just buy the 787-10 and hope for the best. They deployed them with surgical precision. First, premium transcontinental routes Newark to Los Angeles, a business-heavy route where passengers pay extra for LI flat seats and premium service. Then came the transatlantic expansion. United started replacing aging 77,200s and 76-7s on their core European routes. Same destinations, better aircraft, more seats, lower costs. United's 78,710 Polaris cabins offer 44 lie-flat business seats competing directly with British Airways Club Suites, 56 seats on A350-900s or Delta One suites, 30 to 40 seats on A350-900s. United's premium heavy configuration targets high-value transatlantic passengers, but it risks losing ground if competitors' wider cabins gain preference. The 78,710's extra capacity meant more premium seats without sacrificing the passenger experience. The results speak for themselves. United continues holding steady capacity on its 78,710 services to Europe. United also gained massive leverage with Boeing. When you're ordering aircraft by the dozen, manufacturers offer better pricing, priority delivery slots, and enhanced support packages. United turned its 787-10 order into a comprehensive fleet deal that strengthened its entire operation. But this brilliant strategy comes with risks that could backfire spectacularly. First, the airline is locked into specific route types. If travel patterns shift towards longer routes, say direct flights from secondary U.S. cities to Asia, the 78,710 can't follow. United would need different aircraft, breaking its carefully planned fleet commonality. Second, fuel price volatility. Right now, efficiency matters because fuel is expensive, but if oil crashes and stays low, the 787-10's efficiency advantage shrinks, while its range limitations remain permanent. Third, competitive dynamics. Boeing shelved its new midsize airplane project indefinitely. There's no clear path if the 787-10 strategy doesn't work long-term. These aren't theoretical risks. They're real financial risks hiding in United's fleet strategy. But United isn't completely alone, but it is close. Singapore Airlines operate 787-10s primarily for regional Asian routes where range doesn't matter. Etihad uses them for mostly medium-haul routes from Abu Dhabi to Europe and Asia. ANA flies them domestically and to nearby Asian destinations. Notice the pattern. Every successful 78,710 operator uses the aircraft for routes specifically designed around its limitations. Most airlines aren't willing to build their network around one aircraft's quirks. They want flexibility first, optimization second. United flipped that equation and bet everything on optimization within its specific operational envelope. The question is whether that bet will age well as markets evolve. And that brings us to the fundamental trade-off that defines modern aviation. United made a choice that reveals everything about modern airline strategy. Do you buy the most flexible aircraft and accept slightly higher costs? Or do you buy the most efficient aircraft for your specific routes and accept reduced flexibility? Most airlines choose flexibility. United, they chose efficiency. The 787-10 delivers incredible seat-mile economics on routes between 3,000 and 6,000 miles. Pack it with 330 passengers on Newark to Europe, and the unit costs are unbeatable. But use it for anything outside of that envelope, and efficiency turns into liability. United's bet assumes its core route structure won't change dramatically over the aircraft's lifespan. That's a massive assumption in an industry famous for constant disruption. Remember 2020? Routes that seemed permanent for decades vanished overnight. Consumer preferences shifted. Government regulations changed. Oil prices swung wildly. The airlines that survived were the ones with flexible fleets that could adapt quickly. The question is whether United's efficiency-focused strategy can weather the next crisis. For Boeing, the 787-10 story represents a strategic miscalculation designed as a product success. It built an airline that technically works, but it solves problems most airlines don't have. The 787-10 excels in narrow circumstances while struggling everywhere else. Boeing chased a market segment that barely existed and wondered why sales disappointed. Most carriers lack United's route structure, operational discipline, and fleet planning expertise. They need aircraft that succeed despite mediocre planning, not because of brilliant strategy. So, was United's 787-10 strategy brilliant? Or was it risky? The honest answer is both. Brilliant. Because United identified routes where the aircraft's strengths created unbeatable competitive advantages. On packed flights from Newark to Europe, the extra capacity translates directly to profit margins their competitors can't match. Risky because specialized aircraft become stranded assets when markets shift. United essentially bought efficiency at the cost of adaptability. But right now on those packed flights from Newark to Europe, United's 787-10s are doing exactly what they were designed to do, making money one perfectly filled seat at a time. Time will tell if betting against flexibility was genius or folly. But United's 78,710 story proves that sometimes the best strategy isn't buying the most versatile aircraft.